Hi guys, in this video I'll be walking us through the steps in building a Monte Carlo value at risk model for a multi-asset class portfolio. My simulated portfolio here consists of stocks, ETFs and mutual funds. However, this can be extended to other asset classes as long as you're able to get actual or estimated pricing for these instruments. In this video, we aim to achieve four things. Firstly, mark to market our portfolio on a daily basis and from conception till date. Secondly, create an instrument weighted portfolio price for our portfolio. Thirdly, compute the 1% Monte Carlo VaR for our portfolio. And lastly, compute our portfolio's 1% Monte Carlo conditional VaR. VaR is one of the most useful tools an asset manager has at his disposal. This is because it can be used across all asset classes as long as these assets are exposed to volatility in terms of their pricing. VaR helps an investment manager know the level of risk he is exposed to in his portfolio, and it can simulate the addition of more instruments to his portfolio and determine whether these instruments reduce his portfolio volatility or add to it, depending on how correlated these new instruments are to the other assets within his portfolio. Lastly, VaR, particularly Monte Carlo VaR, help asset managers put a figure to their probable losses in the near future and help in decision making as to whether to exit a position due to the probability of unacceptable loss events occurring, or whether to hold this position given that if in the event that their acceptable loss thresholds have not been breached. Starting off, we'll get the stock name for all the tickers in our portfolio. So to do this, I basically use the data tab on Excel, the data function on Excel. I highlight all the stock tickers in my portfolio, then go to data, and under data I see stocks. Click on this. This converts the names. This converts the tickers into stock names. You notice it has done this. It took a bit of time, but it has done that. Now, one thing we need to be careful about is to ensure that the stock that it has brought up is the stock we want. You would notice that PISA, which is PFE here, has a question mark, and if you click on that, you see it's bringing up different results. Basically, there are different kind of PISAs in different stock markets, and there's another stock called PFE in the Australian stock market that has nothing to do with PISA. But since we're working with US stocks in this video, I'm going to select the New York Stock Exchange. Now, going to column G, you'll see quantity. This is the quantity of stock we have in our portfolio at this point in time. H is price paid. Our historical value is basically our quantity times price paid. And if we go all the way down, you'll see that the historical value of our portfolio is $531,000. To get the previous day's closing price, all we just need to do is link that to the stock name dot previous close, and then we get the stock price for Apple and drag down, and then we do the same thing to get the current market prices, almost the same thing, which is linking this dot price, and we get that price and we drag down. Now you'll notice we have a column called market value on column L, and this is basically quantity times current market price, which gives us our market value, and we see our total market value is $574,000. Our daily mark to market simply is our current price minus the previous day's price, and then to get the mark to market gain or loss is just multiplying the mark to market return times the quantity of that stock we have in our portfolio, and we have a mark to market gain of $1,313 for between the 23rd of November and the 24th of November. The next step is to calculate the total gain or loss we've made on our portfolio, and that's just basically the current market value less historical value. And drag this down, and basically we've made a gain of $42,876. The next step we do is calculate the weight of each stock in our portfolio, and this is basically the market value of that stock over the market value of our portfolio, holding the market value of our portfolio constant. It's important because we are going to use this to calculate our fund price next. So we get that. Hold on. So this is how our portfolio is structured. Going to the Monte Carlo calc, you'll notice that we have the prices for each instrument from 2nd of January 2015 all the way to the 24th, of November 2021. And above these prices, we got these prices from investing.com, but you can use any data source you prefer. And above this is our portfolio weight, is the weight of each stock in our portfolio. So basically we're going to use this to calculate our fund price, and our fund price is basically just going to be the stock price as at that day times the portfolio weight. And on the 2nd of January 2015, our portfolio price was $79, weighted average of $79. After calculating this, we just drag down. Notice that you have to hold the portfolio weight for each stock constant when you drag down. And then to get our returns on our portfolio, it will just be basically the current day's price minus divided by the previous day's price minus 1. And this shows our returns on our portfolio for that particular period. Now, after having computed our returns, the next thing we do is we'll compute some variables. Before we do that, though, I would like to advise us to compute a returns array of at least 3 years. What I have here is close to 7 years, starting from the 2nd of January 2015 to the 23rd of November 2021. So these are the variables we'll compute. The first thing we compute is our minimum returns, which is basically going to bring up the most gross or return we've had during this period, and that is the main function of our array. And then the maximum return we've gotten, which is max function of an array of returns. After assuming 252 days in a year, next we calculate our time increment. And because we have 12 months in a year, you'll notice this. We have an average of 21 trading days in each month. So our time increment will basically be 21 divided by the number of trading days. And our count is the number of returns we have over the period of time we're calculating. Then our average daily returns will basically be the average of returns we've observed during the period, and daily standard deviation also calculates the standard deviation of our returns. Now these are daily returns and daily standard deviation. What we aim to do next is to annualize them. The next step is to calculate. I have a random number generator generate 10,000 random numbers. And how we do that in Excel is just basically is equals to rand, open and close brackets. This is an automatic function by Excel, and basically it chooses any number between 0% to 100%, between 0 and 1. The next thing we do is to use the Excel function num is inverse to return the standard normal cumulative distribution of the random number we have generated. The cumulative distribution assumes a mean of 0 and a standard deviation of 1, so we do not need to put in any other function, arguments or conditions. So basically, to return the inverse of this, and this is num.s dot in, and just pick this, and then it returns that, and we drag down for all our 10,000 iterations. Finally, to get our returns, we use the Black-Scholes model pricing formula, which is basically the exponential of our standard deviation, annualized standard deviation, raised to the power of 2, times our time increment, which we've already calculated, times standard deviation once again, annualized standard deviation, times the square root of our time increment, times our computed cumulative distribution, randomized cumulative distribution. Yes, hold on. Let's go to. So we get our returns there, and then we drag down. But before we drag down, we have to ensure that we hold all our variables constant except for our randomized cumulative distribution. And then we drag down. Now we have computed 10,000 possible returns. Now to get our 1% VaR, we just basically do this. A small, take the whole returns that we have computed, the array of returns we've computed, and look for the 100th position. Sorry. Hundredth position. Okay. And we look for the 100th position. So our VaR is, our estimated VaR is 1.162. But since this is Monte Carlo simulation, each time, and it's randomized, each time we run it, that number basically changes. Another thing we need to understand is that our VaR is a point estimate, which just shows what will happen at the 1% significance level. It doesn't show what other losses might occur beyond that, and this is why VaR is slightly less useful than conditional VaR, because while we might have a VaR of loss of probable VaR loss of minus 1.14%, it could go as high as 10%, or even we could in fact lose our total portfolio. So what we do with the conditional VaR is then we now try and take the average of all the worst possible losses, starting from the point interval of that 1% and average them. So how I calculated the conditional VaR was to first and foremost compute the 100 smallest returns or worst possible returns, which is using this formula, same formula, small, the array, first position should be 100th position, and then get the average. So for this condition, while our VaR return is minus 1.145%, our conditional VaR is minus 1.327%. Now, after computing our VaR and our conditional VaR, we go back to our simulated portfolio page and basically impute them here. Check the VaR, hold it constant, and drag down. Do the same thing for 1% conditional VaR. And drag down. Now to calculate our VaR price, it will just be basically 1 plus 1% VaR times our current market price for that instrument. So the VaR price of Apple is 160, and do that for conditional VaR. We also do that same thing, which is equals to 1 minus our conditional VaR, 1 plus our conditional VaR return times current market price. So to compute our 1% VaR, it will just be basically our VaR price minus current market price times quantity. Basically do the same thing for our 1% VaR, 1% conditional VaR, which will be our CVaR minus current market price times quantity of instrument held. So there you have it. That's how to calculate VaR and conditional VaR. Our VaR position shows a probable loss of minus 6 of negative $6,581, while our 1% CVaR shows a probable loss of $7,498. Thank you for watching. Goodbye.